morning, everyone. My name is Cal Everett. I'm the president and CEO of Liberty Gold. Today's presentation, I'm going to start off with an overview of the production side of the mining industry, and then I'm going to finish off with 7 or 8 slides on Liberty Gold. So this is going to be a 2-segment presentation, and we'll start off on the where we are in this current gold cycle. I will be making forward-looking statements. This shows peak gold, and the key number here I want you to pay attention to in this slide is the number 65%, give or take, that where we are today with respect to the drop of the GDXJ, down by 69%, and pay attention to that 60 number. It's going to come up several times in this gold presentation. And even though the GDXJ has gone down that much, the price of gold only went down half of that. And this is an important slide to me because this, and on the production side of the industry, I've never seen an industry on the production side be so dysfunctional to get itself put in the predicament it's in today. The production side acts like a flock of sheep. It's either led by a ram or it's led by a lamb, but they all tend to flock together with a complete lack of foresight on what's going to happen in the future. When economics go in one direction and politics go in the other, it's a template for disaster, and that affects the gold price. And here's just a few slides of what's circling the overall gold market today. There are now 3 regimes left in the world. That would be China, the US, and the European Union. When you go outside of those 3 regimes and you go into the Middle East, Assad has won in Syria. There are no regimes other than the outside edge of the European Union that's going to get involved in the Middle East, and it's just a fact that they have won. If you go into politics, Merkel, May, Trudeau, Macron have all lost support of their voting populace. Yet there's an increase in populism in democratic governments, and you can see it by Trump or in Turkey, that are going to ultimately affect what's going to happen in this industry. With respect to global economics, China rolled over before the tariff war. It was already on down. GDP is rolling over in civilized nations everywhere. And if you go look at the stats on the bottom, 80% of US economists are predicting a recession by the end of this year. 50% of US Fortune top companies are predicting, their CFOs are projecting a recession this year. I'm not sure I agree with that number. It may not happen until next year, but certainly we're going into an economic slowdown. The other key point in this slide is really important. Global debt has doubled since 2008. And it's getting to a point where countries cannot raise interest rates any further for fear of destroying the sacred cow of job creation in the construction sides of the industry. There's simply too much debt. With regards to public equity markets, lower liquidity. 85% of trading volume right now is done by computer programs, passive algorithms, etc. And there are very few people left to talk to the people face-to-face in this room. It's all done electronically. This is a change in the industry. You can see that the corporate bond market rolled over, demand for higher yield in 2017. S&P futures volume is down by 70% in 2017. And we're seeing declining earnings per share of all these public companies, and it's happening now. And then we go into the mining industry itself. This is an important slide. At peak gold, the mining industry got itself into a debt issue. So what they had to do was sell assets to clean up their balance sheets. On average for the industry, the average grade has fallen from 2 grams a ton to 1.54 grams. That's a producing gold mine. That's how far the average grade has declined. And what the companies were doing, they were high grading and they're overproducing gold, and that just rolled over in 2018. At the same time, they stopped spending on repairing infrastructure and exploration, and they lowered that on average by 54%. The net debt's down 58%. Their balance sheets look better, but the future is not brighter. This is a great slide. This came in from National Bank, and I put some of my own information on this. And this shows the discovery of 5 million ounce gold deposits since 1990. Most of the 90s deposits were bulk tonnage, low-grade copper-gold porphyries, where you could actually aggregate 5 million ounces of contained gold, and very few of these are in production today. Then you go into the early 1990s, and you go in and see how the discovery decline is. To 2017, we're down to 1.5 a year, and in 2018, I do not believe there was one. And this is the problem the producers have. No discoveries, no pipeline, and the cost to build some of these projects are going to be well over $1 billion. And the discovery cost per ounce is rocketed to $174 to find a replacement ounce today. This is for the industry. This is a really good slide. It's produced by National Bank. This is a feel-good slide. And this is under the premise that every pipeline projects for the senior mining companies are all built and in production in 6 years. It's an amazing number. And Rand Gold is not factored into the Everett one. And Gold Corp looks great, provided that Kaminak's in production, Sarah Casali's in production, Caspiche is in production, which are all $1.5 billion built, and that is absolutely not going to happen in time. So you can actually see on the mine life, which is most important here, while they were cleaning up their balance sheet, the industry on average lost 3 years of mine life, to a point now where the mine life of a mine that goes into production has to be replaced by another one because the permitting timeline has accelerated so much in terms of going out into the distance. If you go look at Kaminak, that was discovered in 2009. 10 years later, they haven't turned a shovel of dirt on that property. It was bought for $520 million by Gold Corp in 2016, but it is a good project because it's got mine life. And none of the senior producers are going to go out and buy a mine with a 5-year mine life. They're assuming a liability of cleanup, environmental liability, and even if it produced 100 or 200,000 ounces, it doesn't solve their problem. They need mine life, mine life, mine life. And this is what they're looking for. And these are all the things that are affecting the gold market today. And now I'm going to bring in rising geopolitical risk. This is also affecting the industry in a great way. There are safe jurisdictions, there are questionable jurisdictions. But what's happened in the industry in the questionable jurisdictions, these countries are learning from each other. They're learning how to put on super royalties, expropriation of interests, or outright assets from the companies working in those jurisdictions. Only in the last 4 weeks, on Saturday, the government of Burkina Faso stepped down and resigned. That happened on Saturday. Last Wednesday, the Swedish government went socialist. 2 weeks before that, the Finnish government turned to socialism and protection of resources. Over the last month, Kazakhstan have asked the Chinese to leave their country. And that's where the Kumtor mine is for Centerra. In Kazakhstan alone, there's been 14 prime ministers in 20 years. That's how politically uncertain some of these jurisdictions are. And if one man gets divorced 14 times in 20 years, don't look at the women at being at fault. And so this is just the status of the industry as it stands today. So here's one of the problems. There's too many gold producers. There's simply too many. So this includes Gold Corp separated from without the merger with Newmont. And there's 12 producers right now, soon going down to 11, that produce over 1 million ounces. There's 25 that produce 300,000 to 1 million ounces. And then there's 33 juniors that produce up to 300,000 ounces of gold a year. That's the public company side of the industry. I don't have Russian stats. I don't have Chinese stats. So they're not in there. This is just from public companies. There's simply too many producers all in the same predicament. And that's why you're seeing all the M&A activity going on. But when you're doing M&A, you've got to do M&A for mine life. That's the key. And jurisdiction. And here's where the numbers are. This is what their market caps have fallen from peak gold. That's that 65% number I gave you. The volumes have fallen by 65%. This is just a complete reflection in actual market cap of where the industry is going. Now this is the interesting stuff. So if you go take a look at all these stats for all these companies, there are only 214 gold mines in the world that produce over 75,000 ounces. So the Oxygen group of companies, we've been looking at this, and we picked our jurisdiction where we wanted to be in North America to avoid geopolitical risk. But we're not targeting anything that would come in under a production number of 75,000 ounces. And I can tell you as a fact, the larger mining companies are going to go after lower and lower producers, because if you open up your gym locker, 200,000 ounce producers with 10-year mine lives are not falling out of it. Okay, so this is where the industry goes. The location is interesting in the Americas and to less questionable jurisdictions. Half and half are in the Americas and Australia, but there is just a declining number of operating gold mines. And this last slide is very important. This is how we all slide into this pipeline concept. So this is the Liberty Golds, the Pure Golds, etc. There are only 133 projects in the world that could, if economic, produce 75,000 ounces of gold. Of that, 3 of those are owned in this room. The Madsen deposit for Pure Gold, our Gold Strike deposit in Utah, plus our Halilad deposit in Turkey, which we jointly own with Tech Corporation. So it tells you the lack of product that's actually out there, when half of this product a lot of people won't touch because of jurisdictional reasons. There simply is no pipeline, and these deposits have to have a minimum 10-year mine life or they're worthless to the buyer, unless they can see more brownfields potential. And here's my final conclusions on this, which is fairly logical. And the risk to the industry is it makes the same mistake as it did in the past, and they just have to go get into jurisdictions that are questionable again to find the mine life that they're missing now.